Visual presentation. Host sitting in a professional studio setup. Background shows a subtle graphic of the US Capitol building and the IRS logo. On-screen text animations. $6,000 senior tax bonus. Real cash or tax break. IRS Form 1040 update. Host looks directly into the camera with a warm, welcoming smile. Host voiceover. On camera. Are you living in America as a retiree and relying primarily on a fixed income or Social Security? If so, recent legislative updates have brought some incredible news your way. A brand new $6,000 senior tax break. But here is the biggest question on every low-income retiree's mind right now. Can this tax break actually save me real money? And if it does, how and when will that money end up back in my pocket? Later in this video, I am going to break down real-life calculations to show you exactly how retirees at different income levels can benefit from this new law. More importantly, we will discuss how long this tax break will actually last and the strict rules you must follow. Stick around until the end, because a simple mistake could cost you thousands of dollars in missed savings. Visual presentation. Host gestures naturally. Soft background music starts playing. Professional and low volume. Smooth transition to on-screen bullet points outlining the video segments. Host, welcome back to the channel. My name is your name, and here we break down everything you need to know about US retirement, Social Security, and tax updates in a simple, easy-to-understand way. The rapid pace of inflation in recent years has put immense financial pressure on our seniors who are living on fixed incomes. From groceries and prescription medications to utility bills, everything has become more expensive. In times like these, a heavy tax burden is the last thing you need to worry about. To provide some relief, Congress and the IRS have introduced an enhanced deduction for seniors spanning from 2025 through 2028, which seniors are actively claiming as they file their taxes. If you haven't filed yet, or if you are planning for the upcoming tax years, this video is absolutely critical for your financial health. Before we dive into the details, please take a moment to like this video and subscribe to the channel so you never miss verified, timely financial updates. Visual presentation. On-screen graphic showing the breakdown of standard deduction. A visual staircase showing 1. Regular standard deduction. 2. Extra 65 deduction. 3. New $6,000 senior bonus deduction. Highlight the words stacked on top. Host, let's start by defining exactly what this new tax break is. Under this legislative framework, the federal government has introduced an enhanced deduction for seniors. The maximum amount of this new provision is $6,000 per person. To understand this simply, let's look at how filing taxes works. When you file your taxes in the United States, the IRS allows you to subtract a specific amount from your total income before calculating your tax bill. This is known as the standard deduction. Under prior law, if you were 65 or older, you already received a slightly higher standard deduction than younger filers. What this new law does is stack a brand new benefit right on top of that. Now, you get your regular standard deduction, the existing extra senior benefit, plus this new $6,000 bonus senior deduction. Looking at the current figures, a single senior can now protect up to $23,750 of their income from federal income taxes entirely. For a married couple where both spouses are 65 or older, that total deduction climbs all the way up to $46,700. This represents a massive shield against your taxable income. Visual presentation. A clear checklist on screen with green check marks for qualifiers and red crosses for exclusions. Highlight the term Magi with an inline definition pop-up. Host, however, like any significant tax provision, the IRS has established strict eligibility requirements. This is not a blanket benefit for everyone. Let's look at the requirements step by step. The first requirement, age limit. You must turn at least 65 years old by the last day of the tax year. If you are 64, you will have to wait until the following tax year to qualify. The second requirement, identity. You must possess a valid Social Security number SS and valid for employment. The third and most important requirement, income limits. This tax break was specifically targeted to help low to middle-income retirees. Because of this, the IRS uses your MAGI modified adjusted gross income to determine eligibility. If you file as a single individual and your MAGI is under $75,000, you qualify for the full $6,000 deduction. If you are married filing jointly, your combined income must be below $150,000 to claim the full $12,000 benefit, $6,000 for each spouse, who is excluded from this tax break. Pay close attention here. If your income as a single filer exceeds $75,000, the deduction begins to phase out. Specifically, it reduces by 6 cents for every dollar over the threshold. Once a single filer reaches $175,000, or married filers reach a combined $250,000, the deduction drops to zero. Additionally, if your filing status is married filing separately, the IRS rules state that you are completely disqualified from claiming this new $6,000 deduction. This is a common point of confusion, where many retirees accidentally make mistakes. Visual presentation. Animated graphic showing a contrast between a physical stimulus check cash versus an eraser rubbing off a portion of a taxable income graph. Clear visual distinction. Host. Now, let's address the single biggest piece of misinformation circulating on social media and clickbait headlines. Many online videos are claiming that the government is mailing out $6,000 cash stimulus checks directly to your bank account. Let me be completely transparent and direct with you. No, this is not a direct cash payment or a stimulus check. This is a tax deduction, not a tax credit, and certainly not a cash handout. There is a massive operational difference between a deduction and a cash payment. A tax deduction simply means the IRS reduces the portion of your income that is subject to federal income tax. For example, if your total taxable income for the year was $30,000 and you apply the $6,000 deduction, the IRS will now calculate your tax bill based on $24,000 instead. You aren't getting a $6,000 check. Instead, you are being excused from paying taxes on $6,000 worth of your income. The actual cash you save depends entirely on your tax bracket. Since most low-income retirees fall into the 10% or 12% tax brackets, your actual savings will be measured in hundreds of dollars, not thousands in direct cash. Visual presentation. Transition to a clean markdown table on screen. As the host mentions each example, the respective row is highlighted dynamically. No complex formulas, just basic numbers. Host. Instead of talking in abstract percentages, let's look at a few practical, real-world examples. This will help you understand exactly how this applies to your personal financial situation. Let's look at 3 different scenarios based on typical retired households. Real-life tax savings chart to 52026. Profile total yearly income tax bracket potential tax saved actual outcome example. Robert single. Age 68, $22,000. Social Security plus small pension, 10% $0. No change, already owed 0 federal tax, so tax stays at 0. No cash check sent. Example 2. Mary single. Age 70, $32,000. Part-time job plus traditional IRA, 12% $720. Saved taxable income reduced. Owes $720, less to the IRS. Example 3. The Taylors married, 66 and 67. $55,000 combined retirement income, 12% $1,440. Saved received double deduction, $12,000. Keeping significant cash in their pockets. Host. Let's break down these 3 scenarios so you can see the nuance. Case 1. Robert's total yearly income sits at $22,000. In the United States, when you apply the standard deduction for someone his age, his taxable income is already reduced to 0. Therefore, Robert already owed $0 in federal income tax. With this new $6,000 deduction, his tax liability remains at $0 because this is not a refundable cash check. Robert does not receive any extra money from the government. If you already owe nothing in taxes, a new deduction will not put physical cash in your hands. Case to Mary. Mary works a modest part-time job to supplement her retirement, bringing her annual income to $32,000, even after standard deductions under the old rules. She still owed a small amount of federal tax, placing her in the 12% tax bracket. By applying the new $6,000 deduction, her taxable income drops significantly. If you multiply that $6,000 deduction by her 12% tax bracket, Mary saves exactly $720 on her tax bill. That is money she gets to keep instead of sending it to the IRS. Case 3. The Taylors. This is a married couple, both over the age of 65, with a combined retirement income of $55,000. Because both spouses qualify individually, they get a combined extra deduction of $12,000, falling into the 12% tax bracket. This deduction reduces their actual federal tax bill by roughly $1,440. For a retired couple on a budget, that is enough money to cover a couple of months of utility bills or groceries. Let me know in the comments section below. What is your current filing status? And which of these categories do you think you fall into? If you have any questions, drop them down below. Visual presentation. Host's expression becomes more serious and analytical. On-screen graphic shows a calendar starting at 2025 and ticking down, flashing a red boundary at December 31, 2028. Word displayed. Temporary provision. Host. Now let's tackle the critical question. But for how long? Is this new $6,000 tax break a permanent addition to the tax code? The answer is no. This is a temporary provision. Under the current legislation, this tax break is set to run from tax years 2025 through 2028. This means that unless Congress steps in and votes to extend or make this law permanent, it will automatically expire or sunset on December 31, 2028. If that happens, senior tax rules will revert to the older, less generous system starting in 2029. The underlying reason for this expiration date is the long-term federal budget deficit and the projected financial health of the Social Security trust funds, because this policy temporarily reduces tax revenues. It was passed with a strict expiration date. For seniors, this means you have a defined 3 to 4 year window to maximize these tax savings and optimize your retirement budgets. Visual presentation. A visual balance scale on screen. One side has Social Security income, the other side has new $6,000 deduction. Show how the deduction offsets the taxable portion of Social Security. Host. Another question we see frequently in our community is, will this new deduction affect how my Social Security benefits are taxed? The relationship here is very important. To be clear, the fundamental rules governing how Social Security benefits are taxed have not changed. If your provisional income exceeds certain base amounts, $25,000 for single filers and $32,000 for joint filers, up to 50% or 85% of your Social Security benefits can become subject to federal income tax. However, because this new $6,000 provision acts as an additional deduction on your Form 1040, it directly lowers your adjusted gross income. By driving down your overall taxable income, it effectively offsets the tax burden created by your Social Security benefits. In simple terms, while it doesn't change the Social Security tax laws directly, it shields a larger portion of your total income, allowing millions of low and middle-income seniors to completely zero out their actual tax liabilities. Visual presentation. Transition to icons representing different tax credits. 1. Elderly or disabled credit. 2. EITC. 3. QCD. Bullet points appear on screen sequentially. Host. Aside from this new $6,000 provision, there are several existing tax credits and benefits designed for low-income seniors that go unclaimed every year simply because people don't know they exist. Make sure you check these out with your tax preparer. Credit for the elderly or the disabled. If you are 65 or older and meet strict low-income requirements, you may qualify for this tax credit. Unlike a deduction, a tax credit reduces your tax bill dollar for dollar, up to $7,500. Earned Income Tax Credit EITC. Many retirees assume the EITC is only for young families. If you are 65 or older and still earn a small income from part-time work or a small business, you can claim this credit if you meet the modest income thresholds, Qualified Charitable Distribution (QCD). If you are age 70 and a half or older and have a traditional IRA, a QCD allows you to transfer your required minimum distributions (RMDIS) directly to an eligible charity. This money goes directly to the cause without ever being counted as taxable income to you, keeping your overall tax brackets lower. Visual presentation. Red warning banner on top of the screen with the word alert. Warning. Host uses hand gestures to emphasize caution. Host. Now, let's address the dangerous mistakes and scams that you absolutely must avoid. Warning. First and foremost, do not fall victim to misleading advertisements or scam text messages claiming that the IRS is ready to send you an instant $6,000 stimulus refund check if you click a link and provide your banking information. The IRS does not initiate contact with taxpayers via text message or social media, and they are not sending out automated cash checks for this provision. This benefit is exclusively claimed as a deduction when you file a formal federal tax return. The second mistake is failing to verify that the deduction is actually applied to your return. This deduction is not automatically calculated by the IRS unless the appropriate boxes regarding your age are checked on your Form 1040 or Form 1040 Senior, the dedicated tax form for seniors. If you or an inexperienced tax preparer miss these checkboxes or fail to attach the correct schedules, you will miss out on the deduction entirely. Always use reputable tax software or a certified tax professional who is up to date on current tax laws. Visual presentation. Summary slide showing the three main points. Host's tone is reassuring and final. Host. To wrap things up, let's review the most vital facts from today's update. The new $6,000 senior provision is a tax deduction that lowers your taxable income. It is not a direct cash check or a stimulus payment. It is strictly targeted at low and middle income seniors aged 65 or older, with income caps set at $75,000 for single filers and $150,000 for joint filers. The law is temporary and scheduled to sunset at the end of 2028, making strategic tax planning over the next few years highly important. Protecting every dollar of your hard-earned retirement income is one of the smartest financial decisions you can make. Visual presentation, animated graphics for like, subscribe, and share buttons flashing gently on screen. Fine print scroll at the bottom showing the financial disclaimer text. Host. If you found this breakdown helpful and feel better prepared to handle your retirement finances, please give this video a like and share it with your friends, family, or neighbors on Facebook or WhatsApp. Don't forget to subscribe to the channel so you can always stay ahead of important changes to your retirement benefits. An important final note disclaimer. While I am a professional tax analyst, everyone's individual tax and financial situations are entirely unique. This video is intended strictly for educational and informational purposes. Please consult official IRS resources at irs.gov or speak directly with a certified public accountant or qualified tax professional before making any final decisions regarding your tax returns or retirement accounts. Thank you so much for watching. Take care of yourselves, and I will see you in the next video. Visual presentation. Screen fades to black with channel logo, social handles, and the text. Thank you for watching. Stay informed, stay secure.